Hey guys, I want to do another quick 5-minute tutorial on spreads. And it's in transition from the last video I did where I was talking about rolling a covered call. This is also, in conjunction. The basis of the spread that I'm going to be talking about is using a covered call or a cash covered put that you sell, where we sell an option, we get the premium for selling that option, and then we're going to use that premium to either hedge or go long on a stock. And the whole point of doing that is being able to not use the base investment, which is the shares, to then figure out and play, use other people's money or the premium that you captured to then, then you can speculate. So I'm going to show you kind of how that would work. And this is not financial advice. I actually did another video, I didn't say that in, but you can trade this however you want. I don't care. This is just how I trade. So, take this with a grain of salt. Let's get started. So, talk about spreads. And why would we use that? We want to take advantage of significant movement in the stock. Either way, I want to take advantage of some significant movement within the stock. All right. So let's draw out our junky chart. Charts look something like this. So let's say we bought the dip. We'll use AMC. I trade AMC all the time. I sell a lot of calls on it. Say we bought it down here at $33. Okay. Maybe, it's been lower. It's been down here at 27.5 or 28 or 5, or it's been down lower, but whatever. We bought it at 33 bucks, and now here's 34, here's 35, and right now it's at like 33.70 or something. I don't know. It's a Sunday. I haven't looked. Either way, doesn't matter. So what we want to do is, let's say we bought it down here at 33, we wrote it up, and we sold a covered call 35 strike 2 weeks. Okay? And here's our time. Here's week 1, here's week 2. Okay? So time is in this direction. And it's always moving forward. Any chart you look at, it's left to right, and the future is always to the right. That's how we'll measure it out. But let's say, for instance, and we wrote that $35 call because we thought the stock was going to be in this range here. Okay, and let's say we had 100 shares, and that if we sold a $35 call when it was up here, we sold it pretty much at the money. Maybe, you could have sold a 36, could have sold out of the money, but whatever. I sell them really tight because I'm a huge sucker for premium. It's just the way I do it. So let's say I sold 35 for 2 weeks, and I got 400 bucks for that, or $4. Okay. So now I got $4 I can eat with it. I could throw it out the window. You can do whatever you want to with it. It's your money, and you get paid that $4 as soon as you initiate the transaction to sell the covered calls. Well, let's say, for instance, that we think the stock could go up or it could go down. There's some indicator in here, maybe volume's drying up, and we're just like, I don't know where it's gonna go. This is where you can use some of this premium to buy puts or buy a call. Okay? And you're gonna buy out of the money, or OTM. But the only bad thing about when you buy a call is you gotta, or a put, or you're buying options, is the stock has to move quickly in your favor in the direction that you picked. You could do both. So you could have puts all the time, be buying puts at down here at $25. So that way if the stock ever goes down to $25, you could always use some of this put money, $1 worth of it, to buy a put for 2 weeks. Or really 3 weeks is what you want. Because you want to cover the following Monday. Just what I would do. That's just how I do it. But you could always, spend a little bit of that. And you could spend another $1 of that to buy a call. Say a $55 call for 2 weeks. Maybe that cost $1. But you still got $2 of profit. Okay? So we're going to talk more about how it works when the stock moves in either direction. Okay, so now we're going to come out of this consolidation period, and the stock's either going to break up or it's going to break down. And it's a big move. We're talking like 10 points. So we're going to go from 35 to 45 or 25. Okay? And it might keep doing this, or it might just come back up. We don't know what it's going to be, but we think it's somewhere in here is an unknown. We don't know what it's going to do. And you have either an opportunity to roll out, make some more money, or maybe you can write a covered call, and then you can play this motion, and you can play this one. See, that's what's unique about writing covered calls or selling puts. Mostly selling the covered calls I like, because you actually own the asset, whereas with the puts, you don't really own anything. You're actually trying to not get assigned shares. It's a little bit different. With the calls, you can roll up or down and also have your options in play, and which is nice. And you can take advantage of a neutral position when you sell a call. Neutral is only good for selling options. If you own options in a neutral stock, you're just throwing your money away, unless you bought deep in the money or something. It was just, otherwise you're going to lose all your money. So you can play all three vectors, doing that, which is nice. So we think the stock's going to break out. We got $4 of premium to spend. We can spend $1 going long, and we can spend $1 going short. It's not really going short, but you're not actively shorting the stock with puts. You're just betting that the stock will go down, or you're hedging, or you're just utilizing a put to capitalize on the downward swing and the call to capitalize on the upward swing. So now, regardless of what the stock does, if it does it quickly, you can make money on calls that you bought while you still sold that 35. But what's nice is you can, if the stock moves up here and this 35 call expires here at 2 weeks, you can roll this out, this $35 call, up to 40 or 45 or 50 for 5 or 6 or 7 weeks, while you have this $45 call. So you can roll your call too. Don't forget, about being able to roll the call while you own the call, or you bought one. And one thing that you can do with I'll wipe this out. Let's say, for instance, the stock goes up quickly. That $45 call that you have 2 weeks. Let's say the stock goes up quickly and we're like, oh man, I don't know where it's going to go now. It could tank back down to 35 or it could go up to 55. We don't know where it's going to go. You can take this call and you can roll it. And what that'll allow you to do is go out to like a 65. You can go out higher in strike, or an 85, but it allows you to capture profits. And I cannot tell you how much money I've lost because I did not capture profits on options. Being able to do that and roll, and the whole point of the roll is to take the money that you invested in this in the first place and take it out, wipe it off the table. Then you gamble with the profits you made, or maybe you take most of the profits plus the original investment, you wipe that off, take a little bit. So maybe that 45 call went up to, $4. Maybe you take $1 and you speculate with it again. You take $3 and put it in the bank. Okay? Taking profits, not a bad thing. But it's the same thing is true with the put. Roll those puts. You roll them from a 25, you can go down to a 15 or 20. Farther down in strike, farther out in date. And you could do the same expiration if you wanted to. If you think the move's going to be over by then, you don't need to hold on to that. But again, of course, the roll is intended to capture profits. So that's, in a nutshell, and eventually the stock will come back and reset itself and then travel back up again. I know it's more than 5 minutes, but that's kind of the way that it works. I'm sure that there's lots of other ways to trade this. Is just the way that I look at it. Open to plenty of opinions. See you guys next time.